The surge in gold and silver following the latest comments from Jerome Powell was not a speculative anomaly, nor was it a reflexive reaction to a single press appearance. It was a signal, clear, immediate, and revealing, about how capital interprets credibility at a late stage of the monetary cycle. Markets did not move because of what was explicitly announced. They moved because of what was implicitly confirmed. At this stage of global monetary policy, language carries disproportionate weight. Central banks have largely exhausted conventional tools. Interest rates are already elevated relative to recent history, balance sheets remain expanded, and fiscal authorities are constrained by debt dynamics. In such an environment, forward guidance becomes the primary instrument of control. When that guidance loses precision, or worse, coherence, markets respond by repricing trust. Powell's comments were measured, cautious, and consistent with the Federal Reserve's recent posture. However, consistency itself can become a liability when underlying conditions evolve faster than policy narratives. Inflation has proven more persistent than anticipated. Economic resilience has complicated the disinflationary story. At the same time, financial conditions have loosened despite restrictive policy settings. The tension between these realities has become increasingly visible. Gold's reaction must be understood in this context. Gold does not respond to growth optimism or corporate earnings projections. It responds to confidence in the long-term purchasing power of currency and the credibility of institutions tasked with preserving it. When gold rises sharply following central bank communication, it is signaling that the market perceives an erosion, not a collapse, but a slippage in that credibility. Silver's movement reinforces this interpretation. Unlike gold, silver straddles two worlds, monetary hedge and industrial input. Its volatility reflects both liquidity stress and expectations about economic activity. When silver accelerates alongside gold, it suggests that the market is not merely hedging inflation risk, but reassessing the stability of the broader monetary environment. Crucially, the speed of the move matters. Gradual appreciation can be attributed to positioning or technical factors. Sudden repricing indicates urgency. In this case, the market did not wait for additional data releases or follow-up commentary. It reacted immediately, implying that Powell's remarks served as a catalyst rather than a cause. The underlying concerns were already present. This distinction is essential for serious decision makers. Markets rarely change direction because of new information alone. They change when existing information reaches a threshold where prevailing assumptions can no longer be maintained. Powell's comments functioned as that threshold event, not by introducing a new policy stance, but by confirming the limits of the current one. The reaction in precious metals should therefore be interpreted as a diagnostic signal. It reflects a reassessment of real interest rates, currency durability, and policy optionality. Real yields may remain positive on paper, but markets are questioning whether they can remain so without triggering secondary effects in debt servicing, financial stability, or growth. That uncertainty is precisely the environment in which gold performs its signaling function. Importantly, the signal is not aimed at retail investors or short-term traders. It is directed at institutions, sovereign actors, and large pools of capital that operate on longer time horizons. These participants are less concerned with quarterly fluctuations and more focused on regime shifts. Their actions tend to be incremental until they are not, at which point repricing occurs rapidly. The business community often overlooks such signals because they do not immediately translate into operational constraints. Equity markets may remain stable, credit spreads may stay contained, consumer demand may appear resilient, yet monetary stress rarely announces itself through conventional indicators first. It surfaces in assets that exist outside the policy framework, assets that cannot be printed, adjusted, or guided through language. Gold and silver occupy that role. They are not predictive tools in the traditional sense, but they are responsive ones. They react when confidence wavers, not when crises are declared. By the time stress appears in employment data or corporate defaults, the signal has already been sent. The critical question, therefore, is not whether Powell misspoke or whether the market overreacted. The question is, what conditions made the market so sensitive to confirmation? That sensitivity suggests a system operating with limited margin for error. In such systems, stability depends heavily on perception. Once perception shifts, adjustment follows. For entrepreneurs and business leaders, the relevance of this signal lies not in portfolio allocation, but in strategic awareness. Monetary credibility underpins pricing power, access to capital, and long-term planning assumptions. When that credibility is questioned, even subtly, the cost of error increases. This initial surge in gold and silver does not mark the conclusion of a cycle. It marks a warning that the cycle is approaching its constraints. The market has not declared a crisis. It has flagged a condition. Ignoring that flag would be a strategic mistake. The mechanics. How monetary language translates into asset repricing. To understand why gold and silver responded so forcefully, one must examine the transmission mechanism between central bank language and asset valuation. At this stage of the cycle, markets are no longer reacting primarily to policy actions. They are reacting to constraints, specifically the constraints facing monetary authorities as they attempt to balance inflation control, financial stability, and economic continuity. Modern monetary policy operates less through direct intervention and more through expectation management. Forward guidance has become the primary tool because balance sheet expansion and rate adjustments now carry significant secondary risks. When policymakers speak, markets are not listening for reassurance. They are listening for boundaries. Every statement is analyzed for what it implies about what it can no longer be done. This is where language becomes economically consequential. When a central bank emphasizes data, dependence, patience, or caution, it signals uncertainty about the effectiveness of existing tools. That uncertainty directly affects expectations around real interest rates, the single most important variable for non-yielding assets, such as gold. Gold is not sensitive to nominal rates in isolation. It responds to the perceived durability of real rates, meaning rates adjusted for inflation and policy credibility. When markets believe that inflation can be controlled without destabilizing the system, real rates are trusted. When that belief weakens, real rates lose their signaling power, even if they remain positive on paper. Silver's response operates through a parallel but more complex channel. As both a monetary metal and an industrial input, silver is exposed to liquidity conditions and growth assumptions simultaneously. When silver moves aggressively alongside gold, it suggests that markets are not simply hedging inflation, they are pricing in stress within the monetary transmission mechanism itself. In practical terms, this means that capital is responding to the limits of policy flexibility. Powell's comments did not indicate imminent easing, nor did they promise prolonged tightening. Instead, they reinforce the sense that the central bank is navigating a narrowing corridor. Inflation is not receding quickly enough to justify confidence, yet financial conditions cannot be tightened indefinitely without consequence. This tension is critical. Markets are forward-looking systems. They do not wait for policy failure. They price the probability of policy constraint. When that probability increases, assets that depend on stable assumptions, such as long-duration equities or highly leveraged balance sheets, become vulnerable. Assets that exist outside the policy framework gain relevance. Another key factor is the role of currency expectations. Central banks do not operate in isolation. Their credibility is reflected in currency markets, trade balances, and cross-border capital flows. When monetary language introduces ambiguity, it affects not just domestic conditions, but global allocation decisions. Gold, in particular, functions as a neutral reserve asset in such moments, absorbing demand from actors seeking insulation from currency volatility rather than exposure to it. The speed of repricing further underscores this mechanism. Slow adjustments suggest deliberation. Rapid adjustments suggest reassessment. In this case, the market did not wait for confirmation from inflation prints or employment data. It interpreted Powell AS remarks as validation that existing risks had not been resolved and that future policy responses may be constrained by factors beyond inflation alone. This is why traditional market narratives often fail in these moments. Commentators may focus on whether the central bank is hawkish or dovish, but those labels are increasingly inadequate. What matters is not direction, but capacity. The market is asking whether the institution can still impose outcomes, or whether it is now managing trade-offs with diminishing control. The divergence between precious metals and other asset classes also becomes clearer through this lens. Equity markets can remain stable because they are supported by liquidity, momentum, and earnings expectations. Precious metals, by contrast, are sensitive to systemic trust. They move not when growth slows, but when assumptions underpinning growth become less reliable. This distinction is particularly important for business leaders and entrepreneurs. Monetary stress does not immediately translate into reduced demand or higher borrowing costs. It first appears as volatility in signals that most operating models ignore. By the time those signals reach balance sheets, adjustment options are fewer and more expensive. Gold and silver are therefore not leading indicators in the traditional sense. They are constraint indicators. They reflect the market now-yes assessment of how much room policymakers have left to maneuver without triggering unintended consequences. When those indicators move sharply, it suggests that room is shrinking. In this context, Powell's comments served as confirmation rather than provocation. They clarified that the central bank remains bound by competing objectives, each with rising costs. Markets responded by reallocating toward assets that do not depend on the resolution of those conflicts. Understanding this mechanism is essential for interpreting what comes next. The repricing of gold and silver is not a forecast of imminent collapse. It is a recalibration of assumptions. For those making long-term decisions, whether allocating capital, expanding operations, or managing risk, that recalibration deserves close attention. The question is no longer whether monetary policy will succeed or fail in absolute terms. The question is how much confidence the market retains in its ability to do so without destabilizing the broader system. Gold and silver have offered their answer, not in words, but in price, in the markets right now. something I believe a lot of people are completely misreading. If you've been watching the headlines, you've probably noticed a pretty clear narrative. The economy is slowing down, recession fears are lingering, and central banks are signaling a potential pivot to easier monetary policy. This has led many to believe that we're on the brink of a major market downturn. But what if that's only half the story? What if the market is actually pricing in something entirely different? Let's break down the conventional wisdom first. The argument goes like this. Inflation was high, so central banks hiked interest rates aggressively. These high rates are designed to cool down the economy, which they are. We see it in slower housing markets, weaker manufacturing data, and cautious consumer spending. So, logically, the next step is for corporate earnings to fall, unemployment to rise, and stocks to follow suit. This is the narrative that keeps many investors on the sidelines, waiting for the other shoe to drop. It's a simple, linear story, and it makes sense on the surface. But here's where the disconnect comes in. While everyone is focused on the impending slowdown, the market seems to be looking past it. Think about it. Despite all the recession talk, major indices haven't completely collapsed. Certain sectors, particularly in technology and growth-oriented areas, have shown surprising resilience and even strong performance. Why? Because the market is a forward-looking mechanism. It's not just reacting to today's news. It's trying to price in what the world will look like 6 to 12 months from now. And what it might be pricing in is a soft landing or even a no landing scenario, followed by a swift recovery. The market seems to believe that central banks have done just enough to tame inflation without completely crashing the economy. The real story might be that the worst of the rate hikes are behind us, and the anticipated economic pain won't be as severe or as prolonged as the bears predict. The market is sniffing out the possibility that as soon as inflation is confidently under control, the focus will shift back to growth. So what's the big misreading? It's the assumption that the economic slowdown and the market downturn must happen sequentially and with equal severity. Many are fixated on the rearview mirror, looking at the rate hikes and the slowing data. They're waiting for a confirmation of a recession that the market may have already priced in months ago. While they wait for the all-clear signal, which might be a formal rate cut or a rebound in economic indicators, the market could already be well into its next bull run. The big players aren't waiting for the news. They're anticipating it. They see the potential for lower inflation, a pause or pivot from central banks, and an eventual reacceleration of the economy. They are buying the dip on the expectation of that future, not selling based on today's fears. This doesn't mean you should blindly jump into the market. Risks are always present, and the pessimistic scenario could still play out. But it's crucial to understand this disconnect. Being overly cautious and waiting for absolute certainty can be just as risky as being reckless. The biggest opportunities often arise when the prevailing narrative is being challenged. Instead of just following the headlines about an impending doom, maybe it's time to ask what the market is telling us about the recovery that might be just over the horizon. Don't misread the signs by looking at the wrong timeline. The repricing of gold and silver following recent monetary communication carries implications that extend well beyond financial markets. For business leaders, entrepreneurs, and capital allocators, the significance lies not in the metals themselves, but in what their behavior reveals about the operating environment ahead. Markets are signaling a shift in the balance between policy control and systemic constraint, and that shift alters the risk landscape in subtle but consequential ways. The first implication concerns policy optionality. Central banks function most effectively when they retain flexibility, the ability to respond decisively to shocks without destabilizing confidence. When gold and silver reprice rapidly after routine communication, it suggests that markets perceive that flexibility as narrowing. This does not mean policy tools are exhausted, but it does mean that their use carries higher secondary costs. For businesses, this increases uncertainty around future financing conditions, currency stability, and regulatory responses. A second implication relates to the cost of capital. Even in the absence of immediate rate changes, expectations influence behavior. When markets question the sustainability of real rates, long-term capital becomes more cautious. Lenders prioritize resilience over expansion, and investors demand greater compensation for uncertainty. This dynamic does not manifest overnight, but it gradually tightens the environment for leveraged growth strategies. For entrepreneurs, this shift elevates the importance of balance sheet discipline. Access to capital may remain available, but terms become more selective. Projects that rely heavily on favorable refinancing assumptions or prolonged liquidity support become more vulnerable. In contrast, businesses with strong cash flow, pricing power, and operational flexibility gain relative advantage. The signal for metals markets reinforces the value of robustness over optimization. Another critical implication involves currency exposure. In a world of integrated supply chains and cross-border transactions, currency stability is a foundational assumption. When confidence in monetary stewardship weakens, even marginally, currency volatility increases. This affects input costs, revenue predictability, and competitive positioning. Businesses that have not accounted for such volatility may find margins compressed without clear operational explanations. Capital allocation decisions are also affected. During periods of high policy credibility, capital tends to favor growth and duration. When credibility is questioned, capital shifts toward preservation and optionality. This does not imply a wholesale retreat from risk, but it does imply greater discrimination. Strategic investments must clear a higher bar and time horizons shorten. Entrepreneurs planning expansion must therefore reassess not only market demand, but the stability of the financial conditions supporting that demand. Importantly, the metal signal does not advocate a specific asset allocation or defensive posture. Its value lies in diagnosis rather than prescription. Gold and silver are not issuing instructions, they are highlighting stress points. Ignoring those stress points does not preserve stability, it merely postpones adjustment. Another implication concerns planning assumptions. Many business models implicitly rely on stable inflation, predictable policy responses, and gradual economic adjustments. When markets begin to question these assumptions, scenario planning becomes essential. This includes stress testing revenue under different cost structures, evaluating liquidity under tighter conditions, and reassessing dependencies on external financing. For young entrepreneurs in particular, this environment demands a shift in mindset. Growth remains possible, but it must be pursued with an awareness of systemic constraints. Rapid expansion funded by cheap capital is less reliable when monetary conditions are uncertain. Sustainable growth, rooted in operational efficiency and market differentiation, becomes more valuable than scale for its own sake. Finally, there's a broader strategic implication related to timing. Signals such as those from gold and silver appear before conditions force change. They offer a window for deliberate adjustment. Businesses that recognize these signals early can adapt incrementally, adjusting capital structure, renegotiating terms, diversifying exposure, rather than reacting under pressure. The recent surge in precious metals does not conclude the story. It sets the stage for the final question. If markets are already pricing the limits of monetary flexibility, what developments could either relieve or intensify that pressure? The answer to that question determines whether the current environment stabilizes or transitions into a more restrictive phase. That assessment requires moving beyond signals to outcomes, examining what comes next, and how decision makers should interpret the evolving landscape.